I have made more money from market crashes than most people make in their entire lives. Not by getting lucky, not by having inside information, but by recognizing the warning signs that appear before every major downturn. Signs that most investors either ignore or do not know how to read. In 2008, I saw what was coming. While everyone else was celebrating the housing boom and the endless prosperity it would bring, I was quietly positioning for disaster. When Lehman Brothers collapsed and the financial system nearly imploded, I was ready. I bought distressed assets at prices that seemed insane at the time. Bank stocks trading for pennies. Debt trading at fractions of face value within a year. I had made over $4 billion. But here is what most people do not understand. I did not predict the exact timing of the crash. Nobody can do that. What I did was recognize the conditions that make crashes inevitable. The warning signs that have appeared before every major market collapse in history. And when I saw those signs flashing red, I adjusted my positioning accordingly. Today, I am going to share those 4 warning signs with you. These are the patterns I have identified over 30 years of managing money through multiple cycles. The signals that tell me when risk is elevated and caution is warranted. And I have to tell you, I am seeing some of these warning signs right now. This is not a prediction that the market will crash tomorrow. I do not make those kinds of predictions. But it is a framework for understanding when the environment becomes dangerous, when the probability of a significant downturn increases, when smart investors should be paying attention rather than being complacent. Let me start with a story that illustrates why these warning signs matter. It was early 2007. The market was hitting new highs. Real estate prices had been climbing for years. Everyone I talked to was optimistic. At dinner parties, people bragged about their investment returns. Taxi drivers gave stock tips. It felt like the good times would never end. But something was bothering me. The signals I had learned to watch were flashing warnings, not screaming alarms, but persistent warnings that something was wrong. The conditions that had preceded previous crashes were building, and so I started reducing risk. I cut back positions. I raised cash. I prepared for trouble. My investors questioned me, why are you being so cautious when everything looks so good? Are you losing your nerve? Have you gotten too old for this business? I heard it all, but I stuck with my analysis. The warning signs were there, and I had learned never to ignore them. When the crash came in 2008, it was worse than almost anyone expected, but I was positioned for it. While others were scrambling to sell at any price, while funds were blowing up and careers were ending, I had the capital and the composure to buy aggressively. That positioning made my career. So what are these warning signs? Let me walk you through each one in detail. The first warning sign is excessive leverage in the financial system. This is perhaps the most important indicator because leverage is what turns corrections into crashes. Without leverage, prices can fall, but the declines are usually manageable. With excessive leverage, falling prices trigger margin calls, which force more selling, which pushes prices down further, which triggers more margin calls. It becomes a self-reinforcing spiral that can destroy wealth at terrifying speed. Before the crash of 1929, leverage was everywhere. Investors were buying stocks on margin with only 10% down. Investment trusts were leveraged on top of other investment trusts. The system was a house of cards waiting for a slight breeze. Before the 2008 crash, leverage had built up in different forms. Banks were leveraged 30 or 40 to 1. Homeowners had taken out mortgages they could not afford. Complex derivatives had created hidden leverage throughout the financial system. When housing prices started falling, the leverage amplified every move. I look at leverage across multiple dimensions: consumer debt relative to income, corporate debt relative to earnings, financial sector leverage ratios, margin debt in brokerage accounts, leverage in private equity and hedge funds. When multiple forms of leverage are elevated simultaneously, the system becomes fragile today. I see some concerning trends. Corporate debt has grown significantly over the past decade. Many companies borrowed heavily when interest rates were near zero. Now that rates have risen, servicing that debt is becoming more difficult. Some companies are struggling. Some will fail. Private credit has exploded. This is lending that happens outside the traditional banking system, often with less transparency and less regulation. Nobody knows exactly how much risk is in the private credit system because the data is not readily available. That lack of visibility is itself a warning sign. Margin debt in brokerage accounts rose to record levels during the pandemic bull market. It has come down some, but it remains elevated by historical standards. There are still a lot of leveraged positions in the market that could be forced to sell if prices decline. I am not saying we have reached the danger levels of 2007, but leverage has increased, and that makes the system more vulnerable to shocks. When I see elevated leverage combined with other warning signs, my concern increases. The second warning sign is what I call euphoria and speculation. This is the psychological component of market tops. It manifests as widespread belief that prices can only go up, that making money in markets is easy, and that traditional valuation metrics no longer apply. I have seen this pattern at every major top. In 1929, there was a saying that stocks had reached a permanently high plateau in 2000. People said the internet had changed everything and profits did not matter. In 2007, people believed housing prices could never fall nationwide. Each time, the euphoria blinded investors to obvious risks. The signs of euphoria are everywhere if you know where to look. Retail investor participation surges, trading volumes spike, speculative assets with no intrinsic value soar in price. People who have never invested before suddenly become market experts. Financial media coverage becomes breathlessly optimistic. I pay particular attention to what I call the shoe shine boy indicator. This comes from a famous story about Joseph Kennedy in 1929. When his shoe shine boy started giving him stock tips, Kennedy knew the market was too frothy and he sold. The idea is that when speculation reaches the people who are furthest from Wall Street, who have the least information and the least capital, the mania has reached its peak. During the pandemic boom, I saw the shoe shine boy indicator flashing constantly. Social media was filled with young people bragging about their trading profits. Meme stocks were soaring based on nothing but collective enthusiasm. Cryptocurrencies with no use case were worth billions. Everyone seemed to think they had discovered the secret to easy wealth. That kind of euphoria does not last. It cannot last. Eventually, reality reasserts itself. Prices reconnect with fundamentals. And the people who bought at the peak suffer devastating losses. Today, the euphoria has cooled somewhat from the pandemic highs. The meme stock mania has faded. Crypto has crashed and recovered and crashed again. But I still see pockets of speculation that concern me. Certain artificial intelligence stocks trade at valuations that assume decades of perfect execution. Options trading volume remains elevated, with many traders making leverage bets on short-term price movements. The belief that the Federal Reserve will always rescue markets persists, despite evidence to the contrary. I watch sentiment surveys and positioning data carefully. When bullishness reaches extremes, when everyone is positioned for prices to rise, the market becomes vulnerable. There is nobody left to buy. Any disappointment triggers selling. And when everyone is trying to sell at the same time, prices can fall very quickly. The third warning sign is deteriorating credit conditions. This is a more technical indicator, but it has been one of the most reliable predictors of trouble in my experience. Credit is the lifeblood of the economy. When credit conditions tighten, when lenders become reluctant to lend, economic activity slows. And slowing economic activity often leads to falling asset prices. I monitor credit conditions through multiple lenses. Credit spreads tell me how much extra yield investors demand to lend to risky borrowers. When spreads are tight, investors are confident and willing to take risk. When spreads widen, investors are worried and demanding more compensation. Rapidly widening spreads are often a leading indicator of trouble. Bank lending standards are another important indicator. The Federal Reserve surveys banks quarterly about their lending practices. Are they tightening standards? Are they seeing increased demand or decreased demand for loans? Are they worried about credit quality? When banks start pulling back, it is often a sign that problems are developing. Default rates tell me what is actually happening in the real economy. How many companies are missing debt payments? How many consumers are falling behind on their mortgages or car loans or credit cards? Rising defaults indicate stress that often spreads throughout the system. Before 2008, credit conditions deteriorated well before the crash. Subprime mortgage defaults started rising in 2006. Credit spreads began widening in early 2007. Banks started tightening lending standards. The signals were there for those who are watching today. I see mixed signals on credits. Spreads remain relatively tight, suggesting the market is not panicking. But bank lending standards have tightened significantly. Banks are reporting weaker demand for loans. Default rates are rising from very low levels, particularly in areas like commercial real estate and leveraged loans. The commercial real estate situation deserves special attention. Office buildings have been devastated by the shift to remote work. Many are worth a fraction of what they were worth a few years ago. The loans backed by these buildings are going bad. Banks and other lenders are taking losses. This is not a crisis yet, but it is a source of stress that could worsen. I am watching credit conditions very closely. If spreads start widening significantly, if default rates accelerate, if banks pull back further on lending, those would be warning signs that trouble is developing. The fourth warning sign is policy exhaustion. This is when the authorities who are supposed to manage economic cycles run out of tools or lose credibility. Central banks that have already cut rates to zero cannot cut further. Governments that are already deeply in debt have limited ability to spend. When a shock hits and the usual policy responses are unavailable, crashes can be more severe and recoveries can be slower. Before the Great Depression, there was no playbook for how to respond to a financial crisis. The Federal Reserve actually tightened policy as the economy collapsed, making the downturn far worse than it needed to be. Policymakers did not understand what was happening or how to respond. In 2008, we came close to a policy failure. The initial response was inadequate. Lehman Brothers was allowed to fail, which triggered panic. But ultimately, the authorities stepped up. The Federal Reserve slashed rates, created emergency lending facilities, and eventually launched quantitative easing. The Treasury guaranteed money market funds and recapitalized banks. The policy response was massive and ultimately effective. But each crisis seems to require a larger response than the last. The doses of monetary and fiscal medicine keep increasing, and I worry about what happens when the medicine stops working, or when the side effects become intolerable. Today, I see significant policy constraints. The Federal Reserve raised rates aggressively to fight inflation. If a crisis hit tomorrow, they could cut rates, but they would be cutting from a relatively low level compared to past cycles. The scope for monetary stimulus is limited. Fiscal policy is even more constrained. The federal government is already running deficits of $2 trillion per year. Debt to GDP is approaching 130%. Interest payments on the debt are consuming an ever larger share of the budget. If we needed massive fiscal stimulus to fight a recession, where would the money come from? How much more debt can we add? I also think about policy credibility. If people lose faith in the Federal Reserve's ability to control inflation, or in the government's willingness to honor its debts, the usual policy tools might not work. Investors might demand higher interest rates regardless of what the Fed does. Bond markets might revolt against further deficit spending. These are tail risks, but they are risks that did not exist to the same degree a decade ago. Policy exhaustion does not cause crashes, but it makes them worse when they happen. It means the usual circuit breakers might not function. It means recoveries might be slower. It means investors cannot count on being bailed out the way they have been in the past. Now, let me talk about how these four warning signs interact, because a single warning sign is often not enough to cause serious trouble. It is when multiple warning signs appear together that the danger becomes acute. In 2007 and 2008, all four warning signs were present. Leverage was extreme, with banks leveraged 30-1 and homeowners taking out mortgages they could not afford. Euphoria was everywhere, with people believing housing prices would rise forever. Credit conditions were deteriorating, with subprime defaults rising and spreads widening. and policy options were constrained, with rates already relatively low and the banking system in fragile condition. The combination was devastating. Each problem amplified the others. Falling housing prices triggered defaults, which caused losses at leveraged banks, which tightened credit conditions, which slowed the economy, which caused more defaults. The system fed on itself in a vicious spiral. When I assess market risk today, I look at all four warning signs together. How elevated is leverage, how extreme is sentiment, how are credit conditions evolving, how much policy ammunition remains. The answers to these questions determine my overall level of caution. Right now, I would characterize the situation as elevated risk but not crisis conditions. Leverage has increased but is not at 2007 levels. Sentiment has cooled from the pandemic euphoria, but pockets of speculation remain. Credit conditions are mixed, with some stress visible but no widespread panic. Policy options are more limited than in the past but not exhausted. This is not a call to sell everything and hide in cash. That would be an overreaction. But it is a call to be aware, to pay attention, to make sure your portfolio can withstand a significant downturn, to avoid the kind of leveraged speculative positions that get destroyed when corrections happen. Let me give you some practical guidance on how to use this framework. First, assess your own exposure to leverage. Do you have margin debt? Do you own leveraged ETFs? Do you own stocks of highly leveraged companies? Leverage works wonderfully when prices are rising, but it can wipe you out when prices fall. In an environment where multiple warning signs are present, I would reduce leverage significantly. Second, examine your portfolio for signs of euphoria. Do you own stocks that are priced for perfection, where any disappointment will cause dramatic declines? Do you own speculative assets with no intrinsic value, things you bought only because you expected to sell them to someone else at a higher price? These are the positions that get destroyed when sentiment shifts. I would reduce exposure to the most speculative parts of the market. Third, pay attention to credit conditions in your investments. Do you own bonds from issuers that might struggle to refinance their debt? Do you own stocks of companies with heavy debt loads and weakening fundamentals? When credit conditions deteriorate, the weakest borrowers suffer first. I would move up in quality, favoring companies and bonds with strong balance sheets. Fourth, think about how policy changes might affect your portfolio. What happens if the Federal Reserve cannot or will not cut rates in the next downturn? What happens if fiscal stimulus is constrained by debt concerns? Investments that depend on policy support might disappoint. I would favor investments that can succeed regardless of policy decisions. Finally, maintain liquidity. Have cash available. Do not be fully invested in illiquid assets that cannot be sold quickly. When crashes happen, liquidity is incredibly valuable. It allows you to survive the downturn without being forced to sell at the worst prices. It allows you to take advantage of opportunities that arise when others are panicking. I want to be clear about something. I am not predicting a crash. I have learned over decades that predicting the timing of crashes is impossible. Markets can stay irrational longer than anyone expects. Warning signs can flash for years before anything happens. And sometimes the crash everyone fears never materializes at all. What I am saying is that the warning signs I watch are elevated, not at panic levels, but elevated. This is an environment that calls for caution rather than aggression, for defense rather than offense, for making sure you can survive a downturn rather than maximizing returns in a continued bull market. The investors who do best over the long term are not the ones who swing for the fences in every environment. They are the ones who adjust their approach based on conditions, who take more risk when warning signs are absent and less risk when warning signs are present, who survive the downturns and have capital to deploy when opportunities arise. I have survived every crash of the past 30 years, not by being lucky, not by timing the market perfectly, but by respecting the warning signs and adjusting my positioning accordingly. Sometimes I have been too early, sometimes I have been too cautious, but I have never been caught completely off guard. I have never been wiped out. And when the dust settled, I was always in a position to take advantage of the opportunities that crashes create. That is what I want for you. Not perfect market timing, which is impossible, but awareness, preparation. the ability to recognize when conditions are becoming dangerous, and the discipline to act on that recognition. The 4 warning signs I have shared with you today are not secrets. They are well known among professional investors. But knowing about them and actually using them are very different things. Most investors know that leverage is dangerous, but they use it anyway because it feels so good when it works. Most investors know that euphoria precedes tops, but they get caught up in the excitement anyway. Most investors know that deteriorating credit signals trouble, but they ignore the signals until it is too late. Let me go deeper on each of these warning signs, because I think the nuances matter. Understanding not just what to look for, but how to interpret what you see is the difference between being prepared and being caught off guard. With leverage, one thing I have learned is that the most dangerous leverage is often the leverage you cannot see. In 2007, most people focused on mortgage debt. They could see that homeowners were borrowing too much, but they missed the leverage embedded in the financial system. Banks had moved assets off their balance sheets into structured investment vehicles. Insurance companies had written credit default swaps that created enormous hidden exposures. The true leverage in the system was far higher than the visible leverage. Today, I worry about hidden leverage in several areas. Private credit funds often use leverage that is not publicly disclosed. Family offices, which manage money for wealthy families, are largely unregulated and can take leverage positions without anyone knowing. Cryptocurrency markets have leverage embedded in ways that are difficult to track. When I assess leverage in the system, I try to account for what I cannot see as well as what I can see. And when visibility is low, I assume the worst. The other thing about leverage is that it tends to build slowly and unwind quickly. Leverage accumulates during good times, as confidence grows and risk seems manageable. But when trouble hits, leverage unwinds all at once. Everyone tries to reduce exposure simultaneously. This is why crashes are so violent. The deleveraging happens faster than the leveraging. With euphoria and speculation, I pay attention to the stories people tell themselves. Every bubble has a narrative that justifies the elevated prices. In the 1920s, it was that America had entered a new era of permanent prosperity. In 2000, it was that the internet had changed the rules of business. In 2007, it was that housing prices could only go up because they had never fallen nationwide. The narratives are always compelling. They contain elements of truth. The internet did change business. Housing is a valuable asset. But the narratives become dangerous when they are used to justify prices that cannot be supported by fundamentals. When people say this time is different, when they dismiss traditional valuation metrics as outdated, when they believe a new paradigm has emerged, that is when I get worried. Today, I hear narratives about artificial intelligence that remind me of previous bubbles. AI will transform everything. AI will create trillions in value. Companies working on AI deserve whatever valuation the market assigns. Some of this is true. AI will be transformative. But that does not mean every AI-related stock is worth any price. The narrative can be correct while the prices are still wrong. I also watch for what I call the democratization of speculation. When speculation spreads from professional investors to retail investors, from sophisticated traders to complete novices, it is often a sign that a top is near. The reason is simple. Professional investors have capital limits in risk management. When they are fully invested, they stop buying. Retail investors have less discipline. They pile in at the top, providing the final burst of buying that marks the peak. During the pandemic, boom, speculation became completely democratized. Social media created communities of amateur traders sharing tips and egging each other on commission. Free trading apps made it easy for anyone to speculate. Stimulus checks provided capital. The result was an unprecedented retail trading boom that drove some stocks to absurd valuations. That specific mania has faded. But the infrastructure for retail speculation remains. The apps are still there, the communities are still there. The next time euphoria builds, retail investors will pile in again, and that will be another warning sign. With credit conditions, I want to emphasize the importance of watching the trend rather than the level credit conditions can be tight or loose in absolute terms. But what matters most is the direction of change. When conditions are loose and getting looser, risk assets tend to do well. When conditions are tight and getting tighter, risk assets tend to struggle. The transition from loosening to tightening is particularly dangerous. Investors become accustomed to easy credit. They make decisions based on the assumption that financing will always be available. When credit conditions suddenly tighten, those assumptions are invalidated. Projects that made sense with cheap financing no longer work. Companies that depended on rolling over debt find they cannot refinance. The adjustment can be painful. I think we are in one of these transitional periods. Now, credit was extraordinarily loose during the pandemic. Interest rates were at zero. The Federal Reserve was buying bonds. Banks were eager to lend. Companies and individuals borrowed heavily. Now conditions have tightened significantly. Interest rates have risen. The Federal Reserve has stopped buying bonds and is shrinking its balance sheet. Banks are more cautious. The borrowers who took on debt when conditions were loose are struggling with the new reality. We are still in the early stages of seeing how this transition plays out. Commercial real estate is the canary in the coal mine. Office buildings are in serious trouble. Values have fallen dramatically. Loans are going bad. Banks are taking losses. This is happening in slow motion, but it is happening. And the losses could spread to other parts of the credit market. I am also watching the private credit market closely. This market grew enormously when rates were low and investors were desperate for yield. Now that rates have risen, some of the loans made by private credit funds are under stress. But because this market is opaque, we do not know exactly how much stress exists. The lack of transparency is itself a risk factor. With policy exhaustion, I think most investors underestimate how much has changed since 2008. The policy response to that crisis was unprecedented. The Federal Reserve slashed rates to zero, created trillions of dollars through quantitative easing, and kept policy extraordinarily loose for years. The federal government ran massive deficits to stimulate demand. The combination worked. The economy recovered. Asset prices soared. But that policy response had costs. Government debt has increased dramatically. The Federal Reserve's balance sheet expanded from less than $1 trillion to nearly $9 trillion at its peak inflation, which was dormant for years, eventually returned with a vengeance. The policy ammunition that was deployed in 2008 and 2009 and during the pandemic is no longer available. If we have another crisis tomorrow, what can the Federal Reserve do? They can cut rates from 5% to zero. That is something. But they have already done quantitative easing on a massive scale. Will doing more have the same effect? At what point do investors lose confidence in the Fed's ability to manage the economy? What can the federal government do? They can run bigger deficits. But they are already running $2 trillion deficits in a growing economy. What happens to deficits in a recession when tax revenues fall and spending on unemployment and other programs increases? The debt trajectory is already unsustainable. Adding more debt only makes the long-term problem worse. I am not predicting a fiscal crisis or a loss of confidence in the dollar. But I am saying that the policy toolkit is more constrained than it was 15 years ago. The cavalry that rode to the rescue in 2008 and 2009 might not be able to ride as fast or as far next time. This affects how I think about risk. If I knew that the Federal Reserve would bail out markets in any downturn, I might be willing to take more risk, but I am not confident in that assumption anymore. The Fed might want to ease policy but be constrained by inflation concerns. The government might want to stimulate but be constrained by debt levels. I cannot count on policy to save me, so I need to make sure my portfolio can survive on its own. Now, let me talk about how I put all of this together into an actionable framework. I do not assign specific probabilities to market crashes. I do not say there is a 20% chance of a crash or a 40% chance. Those numbers would be false precision. Nobody knows the actual probabilities. Instead, I think in terms of a risk dial that goes from low to high. When all four warning signs are absent, the dial is on low and I am willing to take more risk. When all four warning signs are present, the dial is on high and I become very defensive. Most of the time, the dial is somewhere in the middle, with some warning signs present and others absent. Right now, I would put the dial in the elevated range, not at maximum, but above normal. Leverage has increased, speculation has cooled but not disappeared. Credit conditions are tightening, policy options are constrained. None of these factors alone would alarm me, but together, they suggest an environment where caution is warranted. What does caution mean in practice? It means holding more cash than usual. It means avoiding the most speculative investments. It means favoring quality over junk. It means being willing to underperform in a continued bull market in exchange for protection in a downturn. Some investors will look at my cautious positioning and say, I am leaving money on the table. If the market goes up another 20%, they will be right. But I have learned that leaving money on the table is far better than losing money you already have. The mathematics of losses are brutal. If you lose 50%, you need a 100% gain just to get back to even. Avoiding large losses is the most important thing in investing. The edge comes from discipline, from actually following through on what you know, from being willing to reduce risk when the crowd is still celebrating, from maintaining your composure when everyone around you is losing theirs. I have made my fortune by being disciplined, by watching the warning signs, by adjusting my positioning based on conditions rather than emotions. It is not glamorous. It does not make for exciting stories at dinner parties. But it works. It has worked for 3 decades, and it will keep working because human nature does not change. The cycles keep repeating, and the warning signs keep appearing before every major downturn. Pay attention to leverage. Watch for euphoria and speculation. Monitor credit conditions. Assess policy constraints. Do this consistently. Adjust your portfolio accordingly, and you will be prepared for whatever comes next. I cannot tell you when the next crash will happen, but I can tell you that it will happen eventually. Crashes are a feature of markets, not a bug. They have occurred throughout history, and they will continue to occur. The question is not whether there will be another crash. The question is whether you will be prepared when it arrives. The warning signs are there for those who choose to see them. The framework I have shared today gives you the tools to interpret those signs. What you do with that information is up to you, but I can tell you what I am doing. I am watching. I am prepared. And when the next great opportunity comes, when prices collapse and everyone is panicking, I will be ready to act. Just like I was in 2009. Just like I have been at every major turning point in my career. That is how fortunes are made. Not by predicting the unpredictable, but by being prepared for the inevitable.